For March 2023 with me, Andrew Dawkins, and
myself, Daniel Bajwoluk. How have you been, Andrew?
I've been very well. Thank you very much, Dan.
Yes, good. Very good. And how are the markets fared? I know it's been a bit turbulent in March, so a bit to chat about today.
Just a little bit. So I think we started the month very, very well, and we actually got the FTSE 100 over 8,000 points for a day and a half. And then we got market turbulence again, primarily caused by the banking sector, our old friends in the banks. And that caused markets throughout the world then to retreat significantly, and most asset classes then sort of fell as a result of that. So on the whole, March has been a negative month for most of the funds that we hold and recommend, which is unfortunate.
So turbulent waters all over the world, and what kicked it off last month then?
So it was really the collapse of three American banks, which led to all sorts of kerfuffle. And it was primarily the collapse of the Silicon Valley Bank, which had the greatest effect and was picked up worldwide.
What caused the collapse of SVB?
So really, they were caught out by a few things. Bottom line, poor management, I think. They were holding a lot of long-dated assets, which at the beginning of this year the beginning of 2022 rather, were yielding around about 1%, 1.5% on its long-term mortgage book and its long-term government debt book. But the difficulty was, again, with this increase in interest rates through central banks, the rates have then gone up to 3.5% to 4%, and SVB got a run on deposits where a lot of its investors are fairly tech savvy and were realizing that other banks were giving greater rates of interest and started to move accounts away to their competitors. SVB went into their books and said, right, we'll need to raise some capital, looked at what they've got and realized that actually quite a few of their assets were severely overvalued, and nobody really is wanting to pick up government debt and long-term mortgage debt giving much more than 1% interest. So really they had to downwrite the value of their book, and that caused the bank really to collapse. It unfortunately was one of the symptoms of the easing of regulations that Donald Trump brought in to exempt some of the smaller US banks from making as many declarations regarding solvency as the larger counterparts. So a relaxation of some of the banking laws, which in hindsight is never a good thing to do, because you're assuming that these banks are well run and that they're taking appropriate action. But it turns out that nobody's actually looking really at what was happening in the wider world and what assets they had held on their books. So it was ineptitude by the management, and also the regulator didn't foresee this because of the fact that they weren't reporting as many times and as much detail as the major banks in America.
And closer to home, Credit Suisse was also in the news headlines. So what have you got to say about that arm?
Yeah, so Credit Suisse has been in the headlines for ever since the financial crisis for all the wrong reasons. So I mean, it's probably got more accolades for its crazy decisions and bad underwriting and daft way of operating than any other bank probably in the world. So it's not saying that any bank deserves to go to the wall, but it was very badly damaged for years and years and years. And again, poor management in place. The Swiss regulator let it off so many times, in my opinion, and eventually they couldn't stop the rot any further, and so Credit Suisse was forced to be almost nationalised, or a takeover deal arranged with its biggest rival USBs. So now that really sort of created shockwaves in the banking system, but not really because of solvency or any of the issues connected with the SVB bank, but more for the fact that it was badly run and it had been let to be badly run for a number of years. And that does no end of harm to the finance world when they consider the strength of something like Credit Suisse and the size of market that they have, that they could be allowed to just run a bank so badly as they did. And of course, it ended up not being so much a bank, more of a way of speculating and making money on the money markets rather than the traditional banking sector.
As we always do, try and be as optimistic as possible, Andrew. So any bright spots to look at?
Well, in the US, employment levels continue to be high, and the market continues to be surprised by how resilient the employment market is over there. Inflation in the States is falling. Inflation in the Eurozone is starting to come down as well. There's one or two noticeable exceptions, but it's a sort of a gradually improving position, hopefully. Inflation's still a bit of an issue. What are they doing a little bit of a research? If you wanted to be in the European country with the lowest inflation rate, you would need to move to Luxembourg.
Oh, you're going to make me guess.
Yeah.
I was sweating.
Well, I'll tell you what, I will turn it around then. So which country do you think would have the highest inflation rate?
Germany.
No. It's a good guess, but it's your friends over in Hungary with inflation at around about 26%. But if you wanted to go a little bit further afield, you've got to think about our friends in Turkey. Inflation rate of 55%, for goodness sake. So you think we've got it back. Unemployment rate continues to be quite good here in the UK. We're just around about 4% unemployment, and that compares to Europe's unemployment rate of around about 6%. Now, if we were looking for the best place to go for the lowest level of unemployment in Europe, do you know where we would have to go?
Let's go to Poland.
Well, if the two of us went, right, it would boost the population by about 50%. It's the Faroe Islands with an unemployment rate of just 0.8 of 1%.
Wow.
So probably that chap who takes every other Wednesday off work, it's probably hoping that figure to be pushed up. But there we are. So it's a bit of light relief. The other thing that was quite good for this month was that UK gilts, so lending money to the UK government, they put on the biggest increase in value of many of the funds that we recommend. Obviously, they've taken a huge battering, though, over the last year and a half or so. And so they've got a lot of ground to make up. But what we can see now is a lot of the higher cost debt, a lot of the debt that was really losing out against inflation was sold off during last year and into this year. And now we're starting to see the effects of new higher rate credit coming through, which then boosts funds values. But it's still a long way to go before we get back to anything like we saw pre-pandemic level. So I think we're looking at an improving position with the turmoil costs for the banks. There were individual instances. It's not widespread. There's nothing wrong with the banking system in general. It still needs to be well regulated and well run, though. So always keep an eye on that. But in terms of the world economy, then we are starting to see growth in various areas, especially over in the Far East. Europe's been very, very good. That's our best performing equity market this month. And obviously America continues to shine.
We can't forget that last month also saw the spring budget here in the UK. So anything come from that, Andrew? Whether you know.
Well, apart from rising taxes, then the more positive thing was that the pension limits have now been greatly increased, so that anybody looking to make contributions to a pension that have got money in the bank or the building society, it might be worthwhile considering pension contributions, because now we can put a lot more money within a pension. So that was a good thing. It's always good to have pensions up there as being a very tax efficient form of investing, because we need more people to save for retirement. I think really that was about the only.
I think so.
Another dreadful budget, but anyway, we will see, I suppose.
as we do every month, we look at the A.R.D. Consultancy portfolio funds and how they fared. We're going to be looking at 1 month, 6 months, 1 year, 5 year, and 10 year. And we'll start with the defensive.
So over 1 month, down 0.23 of 1%. Over 6 months, up 5.18%. Over a year, down 7.04%. 5 years, up 7%. And 10 years, up 54%.
And the cautious portfolio?
Over the last month, down 0.62 of 1%. 6 months, up 5.48%. 1 year, down 5.78%. 5 years, up 15%. And 10 years, up 81%.
And the balanced portfolio?
This month, down 0.98 of 1%. Over 6 months, we're up 5.34%. Over a year, we're down 6.65%. Over the 5 years, we're up 23%. And over 10 years, up 113%.
And the capital growth portfolio?
This month, down 1.39%. Over 6 months, we're up 5.52%. Over the 1 year, we're down 5.91%. Over 5 years, up 32%. And 10 years, we're up 135%.
And finally, the aggressive portfolio.
This month, down 1.55%. Up over the 6 month period by 5.84%. Over the year, down 4.5%. Over 5 years, up 46%. And over 10 years, up 164%.